Welcome back to the NWR Resources virtual series. My name is Kerry Stevenson, and you're in for a treat now, ladies and gentlemen, because we've got our keynote speaker, Craig Scheef. He is the he's the Managing Director and Portfolio Manager of Technical Investing, which is a boutique funds management firm. He's had more than 30 years experience working with and also analysing public companies, including just over 25 years directly managing portfolios for clients. But his investing skills have been developed and honed while he's been managing portfolio mandates, superannuation funds, and funds for high net worth individuals. He's also consulted to some of Australia's largest investment funds as a technical analyst. And today he's going to be talking about what's going on with the market and how to analyze the market, especially in resources in these very interesting times that we find ourselves in. Craig, good to see you. Welcome to the NWR Resources Conference.
Thank you, Kerry.
There? There you are.
Thank you, and thanks for the invitation and having me along to speak at the conference.
Is that working, or is it got itself stuck? So while Craig is just testing his slides out a little bit, we had some wonderful NBN technical challenges this morning. Well, Craig did anyway. And so he said, if I have a little bit of problem, bear with me. So
we're good to go, Kerry?
We are very good to go now, Craig.
Excellent, thank you. So thanks for having me along. And thanks to everyone for dialing into the presentation today. It's a pretty big topic we're going to get through. Obviously, resources has got a lot to it, so I'm going to go through the slides pretty quickly. So if anybody would like a copy of those afterwards, happy to be emailed and to send that out as well. So my email will be at the end. Usual disclaimer. And just briefly, just quickly about myself. So I'm not a resources person. I'm not a geo. I have a finance background, started in accounting, moved across into funds management, spent 17 years in Sydney, and then moved up the mid-north coast of New South Wales, where I took a bit of time off and then started technical investing. And we currently operate out of Melbourne and still have an office up the north coast as well. So got a strong fundamental research background, having invested in hundreds of companies over 25 odd years. And where we probably differentiate a bit is we do quite a lot of work on studying human behaviour, behavioural finance, technical analysis, really looking at the psychology of the market and how the markets behave. And that's very important, particularly I think when it comes to resources. And we've got a very strong network of people that we tap into to get that geo knowledge as well. So the fund itself, we analyse both stocks and markets, mainly invest in listed companies. We'll do some unlisted. We're mainly looking for major long-term themes and trends. We're a thematic investor, and then we delve down and look at emerging growth companies to invest in those trends. And we believe that markets move in trends and cycles, and that's obviously very important for resources and commodities because they're very cyclical in nature, and that human behaviour repeats itself over time, and we have ways to track and measure that. We have a roadmap that we look at, which we'll touch on where we are in the cycle and where we should be investing. So the roadmap we did at the beginning of 21 really set out that we expected equities to be in a strong year for 2021. There will be some pullbacks, but it's a bull market that we're in. Be good for stock picking. Small caps should outperform large cap shares, and that we're in the next stage, or we're in the bull market for commodities has commenced. We think that commenced in early 2020. We believe that inflation will return, though if you go back and look at inflation historically, it takes time to build, and we're in the early stages of that building, and we'll spend a little bit of time on that because I think it's very important for commodities. interest rates to remain low, real rates probably to remain negative, and debt levels are obviously very high, and there's going to be longer term issues with those. So where we are today is we don't see the world as having a demand problem. Demand is very strong. If you look at all the recent metrics coming out, economies are returning, and the numbers are coming through as strong. There's huge amounts, obviously, of stimulus has been put in, lots of global liquidity, and there's it's the supply side that's really causing the current issues. The lockdowns, the lack of global movement, causing issues, and these, whilst they are transitory, they're not going to be fixed quickly. And this is going to cause an extended period of supply issues and heightened prices for a longer period than I think a lot are currently expecting. What's also happening is there's a surge happening in capital expenditure. The Economist recently came out with an article, said real world investment is soon going to be 20% higher than pre the pandemic levels. You can see the chart there that, you know, R&D and CapEx looking forward are going to be higher than they were before the pandemic started. And there's a lot of money being spent on R&D. A couple of examples, AT&T's to spend $24 billion on its networks over the coming 12 months. Sony's looking at $18 billion expansion. Apple's looking at a $430 billion over the next 5 years. That's recently been upgraded. And we've got a lot of car companies obviously spending huge amounts of money on EV. So demand's strong. We think that's going to continue. Supply's the issue. And we've got a lot of household cash to be spent. So if we look at the theme, or one of the themes that we really like at the moment, and that is resources. On the chart here is the CRB index. So that's an average of commodity prices. And you can see that peaked in 2008, and really for the last 12 odd years have really been trending down. And there's a lot of chartists that believe that the market tends to work in a what we call a 3-thrust pattern down, or what Elliott would call a 5-wave structure. And that occurred in the commodity index. Other long-term cycle work that we were doing 2017, 2018 was suggesting that late 2019, early 2020 was when the commodity cycle should bottom. That looks like it has occurred, and we've now broken up above this trend line. So this should bring in the new commodity cycle, where commodities now start to trend back up. The chart on the right here is quite interesting. It looks at the number of discoveries made around the world, new discoveries. And you can see when China was doing and growing very fast in the 80s, 90s, 2000, the red bars, discoveries in China, yellows, Latin America, blacks, Australia, and up into the peak in 2008 to 2011 for commodities. Commodity prices were high, people were out looking for new discoveries, and there was a lot being made. And then as the commodity prices fell off, less money was obviously spent looking, and the discoveries fell away. And this is why the next commodity cycle should last for much of this decade, because it takes a while for the new discoveries to come through, and there's been a real drop off. Very quickly, looking at copper as an example, copper's just got to grow at 2 or 3% a year, and we need another 500 to 600,000 tonnes of copper a year. If we look over the next sort of quarter of a century, next 25 odd years, we're going to consume more copper in that period than we have in the whole of the world's history. EVs consume 3 to 4 times the amount of copper. So we see this commodity space, and copper is one of those going to be very strong over the coming years. We've also got middle class expansion of about 150 million people a year moving into the middle class consumption. We've got decarbonisation happening that's going to drive demand into certain commodities. And we've got ESG, which is really going to take longer for new discoveries to probably get into production. So inflation's a topic that's around, people talking about a lot at the moment and having some impact on the market. So we'll have a quick discussion on that. We're seeing a lot of anecdotal evidence that from the companies we speak to that there's inflation returning. There's obviously the supply chain issues. We were speaking to a person with a factory in the US last week, and he was saying the container ships that used to cost him $2,300 to move from Indonesia to the US is now costing him $23,000. Food prices are increasing. Spoke to a restaurateur that has a chain in the US. They're seeing multiple areas of cost increases. It's been well reported used car prices are up strongly, chip shortages, house prices. So there's a lot of inflation occurring. The big question is it transitory? The Fed and a lot of the bankers are saying that it is transitory. We think some of it is, but there's quite a bit that's going to remain. And even after that passes, I think inflation is going to remain relatively high. The other argument that we've got transitory inflation is because of tech innovation, high debt levels, the supply chains, they're going to lead to inflation falling over time. I think that's partially true, but we think the rates are going to remain elevated. There's now 10 million job openings in the US. So COVID has brought about a change in mindset, and people are looking for a different way to work. And it's difficult in a lot of areas to get workers. And so that's going to lead to wage growth. And I think that's what's been missing over the past couple of decades to bring about inflation. And you're not going to have a transitory pay increase. And once those pay increases come through, they're there. So summary, we think price increases, while some are transitory, they will remain, and that inflationary pressures will build. And that's important for commodities because investors are going to be looking for a hedge. They're going to be looking at real assets where they can protect their cash, and commodities and obviously gold is a way to do that. This is a common chart that's brought up, which is really looking at the Goldman Sachs commodity index in comparison to the S&P 500. And obviously it shows at the moment that commodities are underpriced. The US dollar is also very important. All commodities are priced in US dollars, and how it behaves has a big impact on commodity prices. And so the large chart here is a US dollar index monthly chart, and you can see where it bottomed in 2008. That was when commodity prices topped, and commodities on that previous chart also then repeaked in 2011, which was when the US dollar also bottomed again. And then the US dollar has been strong as commodity prices fell over that period of time. But what we think has happened is that strong uptrend in the US dollar has changed, and we're now likely to enter a period of US dollar weakness. Now, back in January this year, everyone was actually expecting the US dollar to fall and the Aussie dollar to go higher. Sentiment was very skewed in that way. And so that sharp move down really had to be brought back in again to relieve some of that excessive sentiment. And that's what's occurred. If we drill down now into a short-term time frame from the US dollar, which has actually just broken out in the last couple of nights, to us, this looks like possibly a false breakout. And once the US dollar falls back below this 93, it will then possibly be a reasonable high likelihood that the US dollar should then start to come back off again. So that's something to watch. Also, the US dollar has impact in a lot of other areas. This is a very interesting chart, which shows the corporate profits in the US in comparison to the US dollar. US dollar was strong, which led to flat US corporate earnings, strong flat corporate earnings. And when the US dollar fell off, US earnings tended to rally. And what we've got now is a period where we've had flat US earnings. And so I think this is going to put pressure on the US currency, and it's going to lead to the US government and the Fed using mechanisms to try and put pressure on the US dollar down. If we start to go through some commodities themselves, so we like the uranium space, we like the energy space. The uranium, this is the URA, which is an ETF in the US, which is a basket of uranium stocks, which obviously did very well in late 2020 and up into mid-21. And then it's had a pullback. What's interesting, this was a classic pullback. Markets, when they retrace, will often retrace around 50% of what the prior rally was, which this did pretty much to the dollar. And here's this 5-wave structure down again. And within those little structures, there was also little 5-wave structures down. So that was a good time to be buying. We've obviously had a strong rally in recent times again. So where are we at if we look more recently? This strong rally, and then this pullback is also now retraced 50% of this rally, which again indicates probably now could be a good time to be looking at uranium stocks again. Copper, big picture on the copper price. When a price tends to get back to a previous high, it tends to have to digest the previous run or it stalls for a period of time. So this is classic behavior, how a commodity or a stock would behave. And if we look now on a short-term time frame, you can see whilst we've had a strong rally, it's consolidated at a very high level, which I think is quite bullish for copper prices. Copper prices may pull back and break this level before they start rallying, but we're either going to rally from here or have a small break and then rally. But we think copper prices look very positive. Gold, very similar chart, consolidating near its old highs, its previous major run. What did it pull back? Around 50%. If we look at the more detail again, we think gold is close to a rally. Again, we may need to come down a little bit lower first, but not by a lot before we start to move higher again. So how are we investing in these themes? We like the EV space. So we've got investments in a bunch of EV related commodities. So what I've done here is just mention some emerging growth companies that we've got exposure to. We invest in other companies, but it's just mentioning one for each sector. So in rare earths, we've got some investment in Peak. Manganese, we like E25. Lithium, actually our exposures through an unlisted company in the US. Copper, it's through a company called QCCU, which is listed on the TSXV. Recently came out with close to 2 billion pounds of copper through their recent resource. Energy, we like CE1. Silica sands, another very interesting commodity that we think can do well. Gold and silver, we've got an unlisted play, and also like Tieto here in Australia. And uranium, we're playing through LOT. Sentiment of the market, I'll just quickly touch on. Back in early 2000, what this looks at is the red is what's called dumb money, and the blue is what's called smart money. And when the dumb money is very confident and the smart money is not very confident, it's a time to be very cautious. And that's what happened in early 2020 before COVID happened. And then we had COVID occurred, the pandemic, the crash. And what actually happened was the ways to measure this, which is just looking at buying of put and call options, money flowing in and out of funds in the US. The sentiment was very positive for the smart money, and the dumb money was very bearish, right at the low. What we've got today is, as the market's starting to come off, we've got the smart money starting to move higher, and the dumb money is obviously getting more cautious again. It's not at extremes, which means the market might have a little bit further to go, but it's starting to get into the areas that we're more inclined to be a buyer of the market than a seller. So I guess summing up, short term, we see a possibility of a little bit further downside in some of the commodities. October historically is a weak month for seasonality for commodities, but we think thereafter that commodities are setting up to do well. The bull market remains intact for equities. However, we should expect some volatile pullbacks along the way. The AAI, which is a measure of sentiment, recently went to 40% bears, which is the highest level it's been since those March 2020 lows. So the caution is building, which we see as a positive sign for the market. So we could be near a trading low. It does look like we could see a little bit more downside, but I think we're getting closer to a turn. Obviously seeing very strong tailwinds for sectors and themes. The US dollar, it's rallied recently. We're seeing signs that it could be starting to turn and that the lagging mining sector is a near turn up. We're obviously bullish for commodities. And we do think we're late cycle though. So as far as the equity market is concerned, so it's a period where people will come into the market and put more cash in, so you can do very well. But we do need to be selective because over the coming years, that bull cycle will end. If anyone would like those charts, happy to send those out if you email us at info@technicalinvesting.com.au. And happy for any questions, Kerry.
Thank you, Craig. And before we take over, let me just say to those of you who are watching, ladies and gentlemen, this is your chance to ask Craig questions. This is the best time because if you've got questions out there, I promise you I'll make sure that I put them to Craig and he can answer them. But before I do, Craig, happy birthday. Little birdie told me it's your birthday today.
Thank you, Kerry.
So I'd like to see lots of comments in that Q&A down there saying happy birthday, Craig. So we appreciate you coming on during your birthday. Craig, it's really interesting, isn't it, when you said the smart money and the dumb money, and how back in March when the market came back about 30%, the dumb money all got scared and rushed out, but the smart money came back in. Are you seeing something similar at the moment? Because I'm seeing, from what I'm reading, a lot of people saying that October could be a bit of a tricky month, that there are potentials for the market to have a bit of a pullback right now. And it seems to me, what with China, Evergrande, with the inflationary cause coming out a little bit, that there's some wobbles going on. What is your view on what the market's doing at the moment?
Yeah, that is what's occurring. That did occur in September. Those concerns from Evergrande and such is being reflected in the market. The market obviously very quickly tries to see those and front run those concerns. So that has occurred. I think it is being reflected. The sentiment numbers that we're seeing is definitely starting to see more concern and bearishness. Again, not at an extreme level like March 2020, but that was really after a market crash. The levels are reaching areas where you would typically in a normal bull market see the market turn back up from. So we do think October is a period, as you said, it tends to be a cautionary month where you can get quite a bit of volatility. We wouldn't be surprised to see the market trend a little bit lower, but we're thinking any sell-off in October should thereafter lead to the market trending higher again. We see much higher prices into 2022.
Yeah, and it's the psychology of investing as well. I mean, James Dine wrote a book on it. When other people are being terrified and getting out of the market, that's when to look at opportunities. I've got a quick question here. What technical investing book do you recommend?
It's good. I've read many of those.
There are so many out there that it's sometimes
there is, and it's probably a couple of decades since I've left. Let me look at my bookshelf. There's a classic one by Edward and McGee that was really a classic chartist book. A lot of the work we do is following a guy called Bill McLaren, who was really mentored me for 10 odd years. So he followed a lot of GAN analysis, cycle work. So anything related to GAN, and Bill did write a book. It's pretty heavy going, but yeah.
But Nick, I got to tell you, that's why I don't look at technical investing books. That's why I'd prefer to go to someone like Craig and say, Craig, because you will look after people's portfolios on their behalf, won't you?
So we don't actually look after their portfolio. We have a portfolio that we manage. So clients come to us, they put cash into our fund, we pull that fund, and yeah, we use those technical tools and fundamental work and meet the companies and manage those funds in that trust for them.
Okay, so people can come to you and it's in a trust and you're looking after it, rather like what you said, some of the companies that you're looking at the moment, both unlisted, on the TSX, on the ASX, etc.
Correct. And when we get to a point in time where we think that the market could be about to completely change direction, so during the GFC, we actually went to 50% cash. We actually put some short positions on in the market. The technical set up quite well for the market to fall. We don't see those signs at the moment. We do think that will come over the next couple of years, but we see this as a pullback in a bull market, which is why we recently did have some short positions on. We've taken those off, and we're quite bullish the coming outlook, albeit short term there could be some volatility.
What sort of percentage do you have in cash at the moment of the fund?
We're fully invested at the moment.
Fully invested, okay.
Fully invested, yeah. So we've recently been adding to our resource positions in this recent pullback, and topped up recently in obviously that pullback in uranium as well.
I love the fact that you're fully invested in resources, because I love resources. It's and there's so many opportunities as I see them. Dev is asking, well, one of my favorite, how can you tell how low gold price can go, and what is your forecast for gold in a year? Now, you did have a chart up there before saying, I think you said that you thought it might have a short-term pullback before a stronger run.
Yeah, so gold at the moment I think is around 1760 odd. It could pull back to maybe 1600, or it might not pull back much further as well. I mean, $100 pullback from here would not be $150. We think is probably the most we would see, or it could just start to move up from here. But I think I don't want to give a forecast higher, but I do see gold as over the next 12 months being a lot higher to where it currently is.
And in terms of, Craig, investing, do you like gold bullion? Do you like gold equities? Do you like the leverage with gold equities?
Yeah, we invest through the miners. We find you do get much better leverage with the miners. Also, we can actually do our research into finding out those individuals that have had success previously, and even if the gold price doesn't do what we expect, those gold miners can still execute and deliver and do well.
Right, just got another couple of questions here. If you've got a question, ladies and gentlemen, I'm telling you, ask it now, because there are no dumb questions, because you did say smart money and dumb money before. There's no dumb questions, ladies and gentlemen, but somebody has said, how do you define smart and dumb money? Well, I guess smart money knows what they're doing. How do you define smart and dumb money?
I mean, those indicators that it's just a term that's used where it's really looking at when people are buying put options and call options, because what tends to happen when markets get to extreme bearishness, people get really concerned. The media is just pumping out that negative news, so they're buying a lot of put options. So that would be a sign of dumb money. Also, people starting to take their money out of the market. So obviously in March last year, where there was a lot of negative news around, probably a lot of people selling, so money there was huge exodus out of the mutual funds in the US at that point in time. So that would get classified as dumb money, and those coming in and buying at that point in time would be classified as the smart money. And there's ways to measure who's buying and selling in those funds, and that's how they get categorized.
And that's the thing, isn't it, Craig, as well, because, you know, the sentiment and, you know, the fear mongering that mainstream media can do to people, and then, you know, they get out of the market just at the time when the opportunity is actually there.
Exactly. There's been some really good studies done why I think they say 80 to 90% of people underperform the major indexes. So the S&P 500, for example, that 80, 90% of investors underperform that index. And why that's simply the case is because when panic and concern hits, that's when they start to sell. And when things are looking really good and their mates are ringing and saying, look how much money I've made in shares, that's when they're starting to put money into the market. And so it's having that contrarian attitude, and you know, it's why, you know, commodities and resources has been very low. It looks like it's starting to turn, and we've got starting to build that bearishness concern in some of the markets at the moment. I actually had a phone call this morning from a broker who called and said one of his clients rang and said, I want to sell all my shares today. So, you know, we're getting to that level where there's peak fear is currently around.
Well, speaking of peak fear and why people sell, what do you look for, Craig, when you're looking at companies? And for example, Tieto Minerals will be presenting later today, and you like that one. What do you look for in terms of, is it management? Is it the commodity? Is it the jurisdiction? What do you look for when you look to invest in some of these commodity companies?
Yeah, number one in anything you invest in is, it's a bit like location. It's management. So, you know, we've probably got half our portfolio in software and technology and half our portfolio at the moment in resources. And it doesn't matter which area you're in, it comes down to management and how they can execute on their plan. So we do quite a lot of work on background checks on management, how have they delivered previously, their expertise, and if they don't have particular expertise, the people around them, or can we bring some help into that? Obviously, jurisdiction in resources is more important. Obviously, particular African countries we won't invest in, other countries we will invest in. And so it's just weighing up that risk to valuation metrics.
Nick is asking, and we're running out of time, so running out of time to ask too many questions more. What has been the performance of your funds in the last few years?
So this year to date, our fund, and these are after fees, after costs, up to the end of August, was up 33%.
Whoa.
Last year, in COVID year, the fund was up 40%. The year before that, I think we were up 37%. So yeah, the last few years, the fund has been performing very strongly. And
by the way, you just also mentioned that was after all the fees, etc. So that's an excellent return. If people need to get a hold of you to find out any more, the email address to send it to you is info@technicalinvesting.com.au. Is that correct?
That's correct.
Fantastic. Craig Scheef, finally, happy birthday. Thank you so much for joining us today. I wish you a fabulous day, and thanks for sharing your knowledge with us.
That's great. Thank you very much, Kerry. A pleasure to be here.